Hello students and welcome to the lecture. So students, as you can see that basically in this lecture we are going to start with the risk in banking sector. Okay, this is going to be our topic for this lecture, risk in banking sector. All right, in this we will cover the credit risk, the market risk, operational risk, liquidity risk, business risk, reputational risk, systematic risk, moral hazard. Okay, then we will do the summary of all these type of risk. But before starting this, there is a small disclaimer that we are required to understand first before we proceed further. So disclaimer is like the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the images. So as we move forward, the first risk is that we have is the credit risk. If a borrower does not repay a loan, the lender may lose the principal of the loan or the interest associated with it. It arises because the borrower expects to use future cash flows to pay current. A credit risk is the danger of default on an application that may emerge from a borrower neglecting to make required installment. Credit risk is most likely caused by loans, acceptance, interbank transaction, trade financing, etc. It means that the person who has liability to repay the amount along with the interest that has been lended to him by the bank or the financial sector is now not able or not willing to pay this. So that is known as the credit risk. Market risk. Market risk arises due to the factors affecting the overall performance of the financial market, and it is also known as a systematic risk. It means that the individual bank has nothing to do with the failures. This is the failures because of the overall performance of the financial market and the financial system. So if the entire financial market will goes down, automatically the banks will have to face the consequences. That is known as the market risk. Operational risk. Operational risk is the risk not arising from financial, systematic, or market-wide risk. It is the risk remaining after determining systematic and financing risk includes risk resulting from breakdowns in internal processes. It means that it is not directly connected with the market-wide risk. Like you can say, suppose if there are three banks, X bank, Y bank, and Z bank. These banks are exposed to the market and the market performance. But their internal procedures are much more higher in operational risk. Because if internally they fails down, then automatically their performance will go down. As per BIS, the Bank of International Settlement operational risk is the risk of loss resulting from failed internal process, people and systems or from external events. Liquidity risk. It is the risk due to the lack of marketability of an investment that could be bought or sold quickly. The inability of a bank to provide cash is known as the liquidity risk. Now the business risk. Business hazard is the likelihood of an organization to have lower than foreseen benefits or experience a misfortune instead of taking a benefit. Like you can say, suppose if there is an opportunity that could be utilized by the bank did not see it or the bank is not able to proceed with it, then it is known as the business risk. Business hazard is impacted by various components, including the deal's volume, per unit value, input cost, rivalry, the general monetary atmosphere, and the government controls as well. Reputational risk. Reputational risk is a threat or danger to the good name of a business, occurs through a number of ways directly as a result of the actions of the company itself due to the actions of an employee, which means that due to several factors or several reasons, the reputation of any particular organization, if we are talking about banking sector, especially we are referring it to the banks or the financial institution, if their name or their brand value, or we can call it combinedly as a reputation, the reputation put at par because of the company's management actions and because of the actions of their employees. It is known as the reputational risk. Because the higher the reputation, the higher will be the business. Lower the reputation, lower will be the business. To avoid reputational risk, a company also need to be socially responsible and environmentally conscious. Reputational risk is the major hidden risk that can pose a threat to the survival of the large companies. The reputational risk arises from the actions of an errant employees who are not that much connected to the procedures set up by the companies. Now, systematic risk. Systematic risk is the ups and downs of the returns caused by the macroeconomic factors. It means not an individual bank or group of banks or financial institutions are involved. It means overall picture is involved here. Macroeconomic. Systematic risk consists of day-to-day fluctuations in a stock's price. Moral hazard. Moral hazard is a situation in which one party gets involved in a risky event knowing that it is protected against the risk and the other party will incur the cost. Arises when both the parties have incomplete information about each other. It emerges when both the parties have inadequate data about each other, so they are not able to decide. Occurs when the borrower notes that someone else will pay for the mistake he makes. This in turn gives him the incentive to act in a riskier way. The economic concept is known as the moral hazard. Now as a summary, we have talked about credit risk by definition. It is a risk of loss if a borrower defaults on a loan, causes loans, acceptance, interbank transaction, trade financing. Market risk definition: risk from factors affecting overall market performance, also called systematic risk. Impact affects all financial assets. Operational risk by definition: risk from internal failures or external events distinct from financial and market risk. Source: breakdown of internal processes, people or systems. BIS definition. Liquidity risk definition: risk due to lack of marketability, inability to sell investments quickly without significant loss. Example: difficulty in a bank providing cash. Business risk by definition: likelihood of lower than expected profit or losses. Influencing factors: sales volume, unit cost, competition, economic climate, regulations. Reputational risk definition: threats to a business good reputation. Causes: actions of the company or employees. Mitigation: companies must act social and environmentally responsible. Systematic risk by definition: market fluctuations caused by macroeconomic factors affects, influences all risky assets including a daily stock price variations. Moral hazard definition: risk-taking behavior when one party is shielded from consequences. Context: arises from incomplete information between parties encouraging riskier actions. So these type of 8 risks: credit, market, operational, liquidity, business, reputational, systematic, and moral hazards represents various challenges organizations face in financial environments. Understanding each risk helps in effective risk management and decision making. So here we have finished this lecture. It is advisable to all of you, kindly revise the facts and figures that all we have discussed in this lecture and keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.